Right. Welcome back. We found our name. Found our name finally. We had everybody at the firm vote. The vote, I think it was unanimous, was it not?
It was.
The weekly rebalance.
Yeah.
I don't know if that's cheesy or not, but we'll see.
I like it. Yeah, we got to get everyone back on track here.
Yeah, I
Cover
like
some
it.
hard-hitting news.
That's right.
I'm sad that
Okay.
it beat out Bed, Beta, and Beyond.
I like that too. Yeah, I like that too. That was our theory on that was that we would have to do that while in bed. Just
Yeah. And
oh,
tired.
yep. First thing in the morning, just start the morning. Just
Yep.
record it before you even get out of bed.
Just half awake.
It's funny.
Exactly.
Well, we came up with our name, the Weekly Rebalance. So podcast that took us 3 podcasts, but we got there. Um, cool. Well, I mean, the interesting thing this week is the Fed, right?
Absolutely.
Pretty pretty interesting day with Powell and some of the other Fed governors commenting, basically saying that they've got a challenging path, which is true. Um, you got two conflicting issues. You got the uh, the risk to the labor market and inflation. I don't know. I mean, what it's hard to say which one's you know more severe. I don't know. What do you think, Nick? What's your I tend to think inflation is a bigger risk, but I understand the employment risk as well. I don't know what you think.
Yeah, it's tough with employment just because a lot of the concern is coming from, we're starting to see signs of weakness, revisions that are way out of date, or at least, considerably out of date. And then I know you sent me that interesting article on how much the new immigration policy is potentially impacting those revisions, and how much that actually entails for the market as a whole, or the labor market, the strength or weakness of the labor market, in all actuality. So I tend to agree with that. Yeah, I definitely tend to agree with that. I think it's really interesting, and it will be really interesting to watch the long end of the curve as the market digests these rate cuts, and we see how much inflation they're really pricing in, how much inflation uncertainty they're pricing in, especially after we get more prints after the initial cut, things like that. But I tend to agree. Yeah, inflation seems to be the bigger concern for me. And I think it's an interesting thing to bring up, especially in the context of, politicians calling for rate cuts, in the context of, mortgage rates, wanting mortgage rates to come down, wanting the debt refinancing rate for the United States to go down as well. Just
Yeah.
because that increased inflation typically increases yields on the further end of the curve, which would, in all likelihood, increase the cost of debt on those portions of the curve, particularly the 10-year, 30-year, especially.
Yeah. Yeah, I know what you mean. I mean, it'll be, I mean, the short end of the curve is what the Fed is affecting. Obviously, that's what they're most directly affecting, right? Yeah, it'll be interesting to see how that actually affects the 20-year, the 30-year, and how that flows into mortgage rates. I mean, typically, historically, they've been able to, um, affect that. But you're right. You got the more debt you take on, the more risk you have that the long end of the curve is stays higher than maybe they want. I was just trying to look and see what 30-year mortgages have come down to now.
Yeah, that was actually interesting. I went to a dinner that the realtor that we worked with put on last week, and I was speaking to the uh, he's basically a mortgage provider, intermediary, and I was talking to him about what he was expecting out of the rate cut decision from the Fed. because this
Yeah.
was the night of the Fed decision. So I was talking to him and I was seeing whether he was locking in rates before the meeting or if he was waiting to see what would happen after. And he was very firmly of the belief and talked to his clients, let's lock in rates before the meeting. And if it goes down, that's something that might happen. But what we've seen in prior meetings in similar environments is actually the 30-year creeps up after that announcement. And that's
Yeah.
actually what happened on Wednesday. So that was interesting to talk to someone specifically in the mortgage world about that.
Yeah. Now, hasn't the 30-year mortgage, looking at the bank rate, 30-year mortgage rate index, now that has come down
Yeah.
significantly here.
Yeah.
I mean, it's come down. The high was January of this year at 7.4. We're now down at 6.3. So we've had more than 110 basis points come out there, which I guess is good for people buying homes. Yeah, bad for inflation though. That illustrates pretty well. The issue though is you see money get cheaper and everything inflates. I mean, look at 2022. That was the problem of 2022 is lots of money, cheap money flowing into the system, and inflation goes to almost double digits. I don't know. I mean, that to me, maybe it's some recency bias because I saw that, you see that happen in 2022. But I just think that, if you just talk to, I mean, again, we're not out doing surveys, but if you just go experience life and talk to people going through life, everything is I am not hearing consistently I'm having trouble finding a job. I need my wages. The only reason they're saying I need my wages to go up are everything's more expensive.
Yeah.
Inflation, and maybe that's misguided, and obviously that's not very scientific, but I tend to think that the inflation risk is probably more severe than the labor market risk, but maybe that's just a bias on my own part. But I think regardless, both are issues, and you can see. I mean, I would not want to be Powell or any of the Fed governors at the moment because it's a decision that you could get wrong either way.
Absolutely.
I don't know how to balance that at all.
No, it's definitely a tricky spot to be in. Because yeah, you see that there has been like signs of beginning weakness in the labor market that's undeniable. It's just in terms of the actual unemployment rate. I mean, I'm taking a look at it here. We're still at 4.3% as
Yeah.
of the most recent reading, and historically, I mean that sounds bad, but historically that's relatively low.
Yeah,
Uh,
exactly.
so just we haven't seen that actual pop yet. And like you said, I mean, just in day to day life, you don't hear that as much as you hear people saying things are getting way too expensive.
Yeah.
Uh, and I think there's a lot of things that feed into that too. We've got tariffs that are about to come into play as well, and probably going to see those costs get passed on to the consumer. Uh,
Yeah.
that's another inflationary pressure. And while it's kind of a one time thing in theory, who's to say that doesn't become like a wage price spiral to some extent?
Yeah. Yeah.
Who's to say the
Totally.
guy's not going to their boss saying, and now I can't afford these things, I need a raise, and that contributes to inflation even further. So there's a lot of things at play there, and I definitely do not envy the position, but I do tend to be a little bit more concerned on the inflation side of things right now than the employment.
Yeah. No, I agree. Yeah. Um, totally agree. It's interesting. I came across well, two things here. One is I heard a joke from a comedian this weekend that I thought was really funny on unemployment, and this was a little bit of an old joke, but they were commenting on. I'll send it to you after or later. I'll tell you. I'll give you the link or something like that. It was they were the employment rate had just gone up to, I don't know, wherever it was. This might be like 15 years old at this point. And it comes there's like the unemployment rate's 6% or whatever it was. I don't remember the exact number he used. He's like, apparently that's shocking to everybody. I think the more shocking thing is that 95% of us here have jobs. Who is hiring these people?
That is a funny comment.
Yeah, but I mean, you're right. Like historically, unemployment is in check, but yeah, you start to see potential cracks there. The other thing that was interesting to me that I came across today that I want to do a little bit more digging into is one, because from our perspective, we have to consider what do we do from a portfolio management perspective? How do we hedge these risks and still have growth in the portfolio? Because you have a position like today. I mean, this is interesting. So today we have the release from the Fed, which is, let's just say they're commenting on the risk of both, which from our perspective doesn't really matter. Both are risk and it's a problem for us to deal with from a port. It's a risk off sentiment from our perspective. So you see what happens today. Like you said this before, I think, but the 6 of the 11 sectors in the S&P 500 were positive today, but the S&P fell. But it's all the sectors that didn't do well the last 10 years, 15 years. Energy, real estate, utilities, consumer staples, healthcare, industrials, all in the green today. While the Magnificent Seven, which make up most of the S&P 500, was down 1.5%, and the total S&P was down 0.5%, 55 basis points. Again, that's one of the reasons why we've been looking to allocate to cheaper sectors that have that just are not so expensive. And we can talk a little bit more about that. But the interesting thing I came across today that I think is pretty valid is looking at like timberland and farmland as an investment. It has a really nice long-term profile that's somewhat like equity returns with very low correlation and a lot less risk. So it's something to consider. I mean, now what I haven't quite figured out is what is the best way to get, exposure to that. At least in liquid portfolios, that can be tricky. But this definitely brings up it highlights some of the risks that we have today, which is looking at these indices that are heavily weighted towards tech and communication services and just really driven by just a few companies in some cases, a handful of companies in some cases that, if those companies are the ones, in my opinion, that have somewhat significant risk to what the Fed is dealing with here. And again, that's one of the reasons why we've tried to diversify into international, diversify into positions that are not as cheap, that have a little bit more solidity, a little bit more solid balance sheets, more profit margins, able to pay dividends, et cetera, just because it's a risk right now. And that today highlights the risk right now. Tomorrow, for all I know, it's going to flip back again. It seems to the last decade, you see this one, it's like, oh, okay, there it goes. It's starting to happen. And then you come back tomorrow and Nvidia's up, 60% in a day.
Yeah. No, it's interesting. I think one of the interesting things too, when you take a look at the sector performance today, kind of similar to what you were talking about, but a little bit of a surprise that I noticed. One thing I was a little bit surprised by, particularly after Powell's commentary, was actually, consumers discretionary, uh, the sector being down. That not to say that every name within consumer discretionary was down today, but
Yeah.
I found that interesting just because typically, something being associated with a rate cut, he didn't necessarily deliver great news today. And sometimes, we've had that bad news, good news in terms of expectations for rate cuts, that sort of thing. And I guess he was a little bit more balanced today in terms of weighing inflation and unemployment, but tended to indicate that we were going to continue this cutting cycle, that sort of thing, which in my imagination or my expectation abstract of anything else going on would be a good thing for consumer discretionary.
Yeah.
So I found that interesting. Just taking a look at sector performance today. I know Nvidia had some specific news come out about it, so
Yeah.
there's that. But that is some interesting stuff.
It's interesting there. I'm looking at the consumer discretionary performance for the day. I mean, it's driven by Amazon and Tesla.
Yeah.
So you know, Amazon's down 3%, Tesla's down 1.9, almost 2%. I mean, that's the interesting thing when you look at some of these sectors. Some of the sectors just don't even make sense. I'm not saying that Amazon isn't consumer discretionary, right? Or Tesla
But they're
isn't.
also cloud computing pretty heavily.
Yeah, exactly. They're also tech companies.
Yeah.
They're
Yeah.
also growth. It's not quite the sector lines have gotten blurred significantly. It's really, in my opinion, it's harder than ever, at least in the last 10 years that I've been doing this. It's harder than ever today to actually, you know, you get less from looking at sector performance than you did in the past, and that's my feeling.
Absolutely. And I think it's kind of an interesting thing. I see it as like almost similar to, how with DuPont analysis, it came from a very specific scenario where they were just saying, how do we break down the growth of this company and where the growth is actually coming from when
Yeah.
it's this big conglomerate, and it was kind of the first of its kind sort of
Yeah.
thing. I almost feel like we need some sort of a solution like that for sectors because of what you're talking about. It's just really tough to pinpoint down, oh, that's a very clearly consumer discretionary kind of thing. That's a because yeah, I mean you're 100% right. A good portion of Amazon's business is consumer discretionary, but increasingly a lot of their price return is driven by their cloud computing software and
Right.
infrastructure. So like, how do you, how do you um, rely on that, especially for some that might be a little bit more connected than others, maybe as opposed to like energy, where it might be a little bit more clear cut, but like consumer discretionary and technology, like where's the line drawn?
Yeah. Yeah, I agree. Like energy is a good example. If I look at all the securities in energy, first of all, there's 22 of them in the S&P. All of them are positive, but they're very like specifically energy, the
Yeah,
big drivers being, Chevron, Exxon, and I mean, we know what they do. They're very clearly in the energy space, but that is like you said, it's not true of everything else. So I don't know. We'll see more to come on that for sure. But that highlights the risk that we're putting out there. And again, we can't reiterate this enough. It's not that we think Amazon, Nvidia, Apple, Microsoft, whatever, any of these Magnificent Seven are bad companies. Of course they're not, but they are. They're pricey.
yeah,
They've been the beneficiary of the last 15 years, and we know that doesn't just last forever. So again, this is one of the reasons we just rebalance away from it. It's a hard thing to, you know, I don't know. I feel like we're seeing this indirectly a lot, but a lot of clients they just can't understand why you wouldn't just keep buying growth and the Magnificent Seven. Just you'd think some of these sometimes that people just that's all we should own is those seven stocks, which you know, from an educate, you were talking about this the other day with me, Nick, the, building portfolios. You could spend years studying to become a portfolio manager, go through all kinds of, you know, you could go through the ringer trying to figure out, become the best portfolio manager you could be. It doesn't mean you know what the stock is going to be priced at in a year from now. You're just trying to do it. A lot of what we do is risk management as much as it is total return. Because at the end of the day, I mean, the last 15 years, if you were just bought those seven stocks,
yeah,
which people were, it wasn't like those, that's the crazy thing. Those seven stocks were not small companies 7 years ago either. They were popular names to purchase, and a lot of people own them in their portfolios now. Maybe Nvidia is the exception, and so in the Magnificent Seven, that was nowhere near where Apple or Microsoft is 15 years ago. But 15 years ago, I mean, it's a again, it's been a it's been an interesting ride, but I feel like clients are, it's easy to just say, well, just keep picking those seven stocks that keep winning for me. And again, a lot of what we do is risk management as much as anything else.
yeah, absolutely, definitely. Just making sure that everything's in alignment too, because sometimes that client that wants to keep buying NVIDIA doesn't necessarily have the risk tolerance when things start to swing the other way.
Right, right. Yeah, exactly.
But yeah, making sure that things are in alignment, making sure that there's not, just a outright mistake in terms of aligning goals with actual underlying positions that are being purchased, or the style of positions that are being purchased, making sure that we're doing it in a thoughtful way that actually makes sense. Because otherwise, you can make a ton of money, but it's probably coming from luck as opposed to actual skill and
Yeah.
determining where a good place to be in your portfolio, and making sure that that lines up with your goals and ability to take risk, not just kind of swinging for the fences and
Yeah.
hoping it
Yeah.
works out.
Yeah, exactly. So, well, I guess that's the theme of the day, risk management, right?
Risk management. That's why it's important to rebalance with the weekly rebalance.
That's right. I like it, tying it in.
Since we introduced it today.
Yep, tie it in. That sounds good. Well, I feel like that's a good way to wrap it up for this week. Unless there's anything else you had on your mind that you wanted to cover, Nick.
No, that was pretty much it. Some interesting stuff out there. So
Yeah, sounds good. Well, we'll be back next week, same time. All right. Thanks everybody. Thanks, Nick.
thanks.